On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning team, hope everyone is well. Today we are going to talk about inflation, and more importantly, why lower inflation doesn't mean lower prices. We got some new inflation figures recently and they showed that New Zealand's inflation rate had picked up in the June quarter. The headline consumer price index, the CPI, is rising at an annual pace of 2.7%, or at least it was in the June quarter. Now that's the highest that we've seen in 12 months, and it was actually a little above Reserve Bank of New Zealand forecasts. I don't think the Reserve Bank will be too bothered by that. They would have known that it was going to be a little hotter than they expected. They finalised their forecasts in May, and they would have seen the same data that we've seen since then. So they won't be too panicked by that. And while the inflation rate is nearing the top of their target band of 1 to 3%, at least it's still in the twos. So sitting at 2.7, getting up there, but at least it still starts with a 2. Also, that 2.7% print for June was actually a little lower than economists were expecting. So that's good news. And that is why we've seen the odds of an OCR cut this month in August increase after those figures came out, because the inflation figures were a little bit softer than what most economists were picking. Remember that the Reserve Bank is tasked with keeping inflation near the 2% midpoint of that range, 1 to 3, keeping it near that 2% midpoint over the medium term. What that means is that it's more concerned with how inflation is developing when you look ahead 12 months, 18 months, rather than what's happening over the next quarter, the next 3 months or so. So they are willing and able, and in fact they're mandated to look through any of these short-term deviations or temporary spikes or dips and really think more carefully about where inflation is going over the next 1 to 3 years. So it's in that sort of 18-month zone that is really the sweet spot for what the Reserve Bank is thinking about. And in that regard, while it does see pricing pressures intensifying over the next few months, it actually sees inflation picking up even further. It still believes that the headline inflation rate will average very close to 2% through all of 2026. For a couple of quarters in the middle of next year, it's expected to dip down below 2%, according to Reserve Bank forecasts. So I think they'll still be pretty happy, and I still think you'll get that OCR cut later this month. Now, part of their confidence that inflation isn't going to get away on them is because of the spare capacity that we're seeing across the economy. Remember, unemployment has been trending higher, and that labour market slack is likely to keep a lid on pricing pressures. So that makes the OCR cut later this month quite likely, and that would take it to 3%. After that, there could be one more in the tank. We'll just have to wait and see. Depends how the rest of the year plays out. But it's not all good news, because even if we can declare inflation beaten, the effects of the cost of living crisis will still linger for some time. And this is what matters most for New Zealand households. There's also a really important distinction that we need to make when we're talking about inflation and the cost of living. Because remember, inflation measures the rate of change in prices, not the level of prices. So lower inflation doesn't mean lower prices. It does not mean that prices will come down from where they were. Even though inflation is now comfortably back in that RBNZ target zone of 1 to 3%, the job is done. Inflation's headed back to 2% or even a little bit below that for parts of next year. Prices are still going up. It's just that they're rising at a slower pace than they were a couple of years ago. But they're still rising. Not rising by 6% or 7% anymore, but still going up 2%, 3%. The CPI basket overall is 25% higher than it was 5 years ago. So depending on how your household lives and what you consume, and we're all different, you might be facing cost pressures that are even higher than that compared to 5 years ago. There have been some things that have fallen in price over that 5-year period, things like telecommunications equipment, audio-visual equipment, computer equipment. Those categories are all genuinely cheaper today. Prices are lower than they were. Furniture, clothing, vehicles, household appliances, those things have risen, but only modestly. So when you adjust them for wage growth, they could be considered more affordable too. The labour cost index, which is a good indicator of overall wage growth in New Zealand, is up just shy of 17% over the past 5 years. Now, that's the strongest rise that we've seen in about 30 years, but it still hasn't kept up with inflation. Another important point is that many of the things that have become more affordable are nice to haves. And in contrast, many of those unavoidable essentials have risen much more sharply. Insurance, property rates, they've soared 35% and 45% respectively over that period. The transport and food groups are up 27%, 28% each over that 5-year period. So that's really important, and it's something that we need to understand when we start to get excited or encouraged by lower inflation and those headlines we're seeing that it's under control. All of that is great stuff, and we should be happy about that. Finally, the Reserve Bank has got inflation back to where we want it to be. However, the thing with inflation is that its effects are cumulative and they compound over time. Once prices rise, they don't fall back. They either stay the same and go sideways, or they go up more slowly, and that's what you're seeing at the moment. So the pace of the increases might have slowed right down, but we are still stuck with those big price rises of the last few years. So even though the economy is hopefully turning a corner and there are better times ahead, those higher baseline prices are still set to remain a headwind for some time yet. Thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.